Did you watch today's news? A company that issues cryptocurrency stablecoins has been listed on the New York Stock Exchange. A coin-issuing company has gone public. If you think there's nothing wrong with that, let me change the order of this sentence. Public companies can issue coins. Think about it. You should be able to feel the power in that, right? This is practically a bomb. The entire financial industry is about to be restructured. Aside from that, some observant friends should have noticed the moves of smart money recently have been very strange. For example, stock guru Warren Buffett has been rapidly reducing his holdings in bank stocks. We can see that Berkshire Hathaway filed its first quarter holding report on May 15th. The report shows that they have completely sold off their Citibank stock. At the same time, they have also significantly reduced their holdings in Bank of America stock. You have to know that Buffett's position in Citibank was built in 2022. For someone like him, who practices long-term value investing, to sell off this position completely after holding it for 3 years, it means that they are no longer optimistic about the banking industry in the short term. The two events I mentioned above, on the surface seem unrelated, but if you dig deeper, they are closely related to a bill that the United States is about to pass next week. This bill is all right today. Let's analyze this stablecoin bill that's snatching the banking sector's meal. First, what is a bill? Simply put, it is a proposal for a law. Once the bill passes a vote in both houses and the president signs it, it will become law. Now, this stablecoin bill actually isn't the only one. The earliest version was actually proposed by the Democratic Party in 2020, and it was called the Stable Act. But this bill was not passed at that time. The stablecoin bill they proposed limited the issuers to institutions that have bank licenses. In other words, only banks can issue stablecoins. If this bill had passed at that time, the biggest beneficiaries would definitely be the banks, and it would be a huge blow to the cryptocurrency market. Why? Because the largest issuer of USDT, Tether, would not be compliant. Tether is not a bank. If this bill passed, Tether would be breaking the law. If Tether breaks the law, the whole stablecoin system would be in trouble, and the crypto market would definitely collapse. Fortunately, in 2020, this bill did not pass. Now, today's version, this genius bill, is very friendly. Such a friendly version has finally reached consensus, but not exactly. When the Senate first voted on it, on May 8th, it was surprisingly rejected. The main reason for the rejection was as follows: an issuer's status would allow the president and officials to issue coins, which can easily lead to corruption. You might not feel how big the interests are behind issuing stablecoins. Let me give you a piece of news to help you understand. This is a piece of news you should be familiar with. Recently, Abu Dhabi announced they invested $2 billion in Binance. Right, about this. We all thought that's a good news for Binance. But according to our investigation, Trump's son, Eric, announced at the K249 conference that the $2 billion investment was settled in USD1. What is USD1? It is a stablecoin issued by the Trump family. What does this mean? It means that Middle Eastern tycoons sent their $2 billion to the Trump family's bank account. Then the Trump family gave a bunch of virtual USD1 to Binance. So what Binance received was a heap of stablecoins, USD1, while the $2 billion is still sitting in the Trump family's bank account. This $2 billion is sitting in the account. And do you know how much interest that is? At a 4% interest rate on US short-term treasury bonds, that's $80 million per year. $80 million. If you want to embezzle it, it's not that easy. You know, during Biden's 4 years as president, the total amount of corruption accusations against his family was just $30 million. In 4 years, the whole family only managed to embezzle $30 million. But with one stablecoin issuance, this one transaction instantly generates $80 million in legitimate income. This single deal is enough for the Biden family to work for 8 years. So now you should have some understanding of the benefits behind stablecoins. Now that we've discussed the interests behind stablecoins, let's talk about the impact this bill will have on the future of the world once it passes.
Let's take a small to large approach. First, the most direct impact of the stablecoin bill is on the stablecoin market. The bill stipulates that any institution wishing to issue a stablecoin must back it with equivalent, highly liquid assets. Specifically, these assets include 1.USD cash and Federal Reserve securities. 2. Bank demand deposits. 3. U.S. Treasury bonds with a maturity of less than 93 days. 4. Reverse repurchase agreements under 7,000.5. Funds that invest in the above four categories of assets. 6. Central bank reserves. In other words, if you want to issue stablecoins, you just need to hold equivalent reserves of highly liquid cash assets. This threshold isn't very high. Existing stablecoin companies can easily meet this threshold with some effort. For example, Tether, USDT, Circle, USDC. These companies can easily meet these requirements and become compliant. So this is a positive for these companies. However, other types of stablecoins in the market may not be as lucky. For example, stablecoins backed by oil, gold, or bonds, and algorithmic stablecoins that have been around for over a year would be considered non-compliant after this law is enacted. So this bill is not universally beneficial for every stablecoin project. Next, the second impact is on RWAs, real-world assets. The Stablecoin Bill specifies that stablecoins are tied to certain amounts of USD or US Treasury bonds. The underlying assets are USD and US Treasuries. So, this bill is essentially about putting USD and US Treasuries on the blockchain. USD and US Treasuries are real-world assets. Therefore, the compliance requirements for stablecoins in this bill are essentially the same as the regulatory requirements for RWAs. 1. Public audits. The underlying assets need to be audited and made public monthly. 2. Responsibility confirmation by executives. The CEO and CFO must sign a declaration of the accuracy of their reports. 3. Third-party custodianship. Clients' assets must be independently held, ensuring proper accounting to prevent misuse or conflicts of interest. This means that project teams won't be able to misuse user assets or engage in unethical practices. It's expected that other RWA assets, such as stocks and bonds, will also follow this regulatory framework, helping to push the adoption of RWAs. Now, let's talk about the broader impact on the crypto industry. We've previously mentioned in our videos that U.S. Treasury Secretary Janet Yellen said in a public statement that she believes the scale of stablecoins used to buy government bonds could reach $2 trillion in the future if, according to the bill, stablecoins and U.S. Treasury bonds are one-to-one linked. Then buying $2 trillion of U.S. bonds essentially means issuing $2 trillion in stablecoins. So, where will this $2 trillion go? Of course, most of it will still remain in the crypto market. Currently, the total market value of the entire cryptocurrency industry is only $3 trillion, and this $3 trillion is supported by only $200 billion in stablecoins. Now, the scale of stablecoins is set to directly reach $2 trillion. What does it mean to increase by 10 times? Next, let's talk about the international impact. The international impact mainly lies in international payments. Previously, the solution for international payments was mainly through the SWIFT system. Banks from various countries joined the SWIFT system to transfer different currencies between countries, but this system has major issues. It's slow, has extremely high transaction fees, and it doesn't work on weekends. That if you want to transfer money from the US to Thailand on a Friday, it won't arrive until the next Monday. Now, with blockchain-based stablecoins backed by the U.S., plus the fact that cryptocurrency payments are fast and cheap, this will mean that more international trade partners will begin to adopt crypto stablecoins for payments. Furthermore, with U.S. regulation, there are KYC restrictions on stablecoins. This requires audits and requires real name authentication. This regulation can ensure that the U.S. government can monitor the global use of USD stablecoins, while retaining the advantages of the previous SWIFT system. It also solves the issue of not working on weekends. Now, let's discuss the broader impact. Could this solve the U.S. debt crisis? Let me share my personal opinion first. I certainly support this hypothesis that we can come to a conclusion through some data. Currently, the largest asset type held by stablecoin companies is U.S. Treasury bonds. For example, Tether, the largest issuer in the market, has issued $150 billion in USDT. Out of that, $120 billion has been used to purchase U.S. Treasuries. The scale of 120 billion US dollars in US bonds has already surpassed the entire US Treasury holdings of Germany. This scale has made Tether the 19th largest holder of US Treasuries in the world. So, as the scale of stablecoins grows, the amount of US Treasuries they need to hold will also grow, which can, to some extent, help alleviate the pressure on US debt. Currently, US debt has a large scale, but 38% of it is held by the Federal Reserve and the US government. Essentially, the debt issued is bought by the government itself. The interest from this portion is effectively left pocket to right pocket, meaning it doesn't really cost the government anything. The real interest pressure falls on those who actually pay the interest, which are the vast holders of US Treasuries. When stablecoin issuers buy US Treasuries, they become a compliant entity for the US. The interest they pay is also left pocket to right pocket, as the government can tax these companies and take back the interest they paid. Truly shameless. As the stablecoin market develops, the structure of US Treasury bondholders will change drastically. The US government will have even greater control over the interest on US Treasuries, which will in turn increase the stability of US Treasuries. Now let's discuss the positive impacts so far. Next, let's talk about two negative impacts. The first and most negative impact is that it will directly affect the US banking industry. That if the stablecoin market can really reach trillions of dollars in scale, and the ones who can conduct such business aren't just banks, it means that banks will face immense competition, and as stablecoins become more popular, a lot of the liquidity in people's accounts that should be in USD may end up being stored as USD stablecoins. So, in the banking sector, the part of demand deposits will decrease, which will reduce the saving scale. This will affect the bank's ability to provide mortgages. So, the business will face significant shocks. I believe this is also the reason why Warren Buffett has been clearing out his bank stocks. The second risk is for countries like Turkey, Argentina, where their national currencies are unstable. These countries will face significant risks. After all, USD stablecoins are recorded on the blockchain, and theoretically, they are not subject to foreign exchange controls. Residents from various countries can buy these stablecoins, and if the national currency is weak, highly volatile, and facing severe inflation, people in these countries will gradually abandon their national currencies and start using USD stablecoins. These countries will slowly become financial dependencies of the U.S., losing any independence. Now I've said a lot. Assuming that the bill passes smoothly. Of course, we must return to the reality. Currently, the motion for this bill in the Senate has passed for a week. After that, it may soon go to a vote. Once the vote passes, it still needs the president's signature. However, the president has yet to sign. After the president signs, there will be a one-year adjustment period. The bill will most likely take effect in 2026, so it's very possible that in 2027, it won't be a bear market, but a much bigger bull market. As the saying goes, riding the wind to set the sail. It's a great honor to witness with you the moment when the crypto industry and the global financial industry change history. $1 million Bitcoin is just around the corner.